Welcome to Real Estate IQ Wisdom for Smart Moves. Featuring Sean Grovier, a seasoned loan officer from Golden One Credit Union.
So what is adjustable rate mortgage?
An adjustable rate mortgage, we'll call it an ARM, it's also known as a variable rate mortgage, is a loan that is fixed for a certain period of time and then becomes adjustable. So you'll hear anywhere from a 3, a 5, a 7, or a 10-year ARM.
Mm-hmm.
And that means it's fixed for that first period, 3, 5, 7, or 10 years. And then it adjusts after that period of time.
So the interest rate is fixed. When you say fixed, what is fixed?
The interest rate is fixed for that first 3, 5, 7, or 10-year period.
Okay.
The loan is tied to an index. They used to be tied to the 1-year treasury. Most companies have changed now to what's called the SOFR. It's a little bit more stable index. So there's an index and a margin.
Mm-hmm.
The margin stays the same no matter what.
Margin is what goes to the bank or the investor.
Well, more so, yeah. But it's the floor rate also. If the index were ever to drop to 0, the margin is usually 2.75. So the rate will never be lower than 2.75.
Okay.
But that index, as it moves, you add the index to the margin, and that is what your rate would be at the adjustment period after the 3, 5, 7, or 10 years.
So when should people consider an ARM product versus a 30-year fixed mortgage product?
Well, an ARM product is a great product if you know for certain that you're going to keep the house for a short period of time, or if your monthly payment is of concern to you, because the payment can be quite a bit less than on a 30-year fixed loan. 30-year fixed loan is a great loan if you know with certainty your income's always going to be the same or going up, and you know that you're going to be keeping that house for at least 10 years. Before 10 years, you might want to consider an adjustable rate mortgage. But it all has to do with what those rates are at the time that you're thinking of buying. There were times when, and not long ago, just 2 years ago, 30-year fixed loans were very, very low. And
right.
We did a lot of them because it wouldn't make any sense. When they were 2%
right.
and 3%, there'd be no reason to get an adjustable rate mortgage. So there's a lot of people that are probably not going to refinance unless they have that credit card debt that we talked about, or that life event where they want to send a kid to school and pull money out of their house for whatever reason, add the pool, do the kitchen, whatever. Those are reasons why they might want to consider the refinance. But other than that, most likely the people that bought their home 2 and 3 years ago got that 30-year fixed loan. They're probably not going to change it. Now, with interest rates being so much higher, adjustable rate mortgage would make a lot of sense. Interest rates are not going to stay as high as they have been this past year and are now.
I see.
Forever. They are going to eventually come down. As we see inflation coming down and other things going on in the market, we're going to see interest rates coming down. So it makes a lot of sense right now to consider that adjustable rate mortgage, because anybody buying a house right now, they're not going to keep that loan for very long. They may keep it for a year, year and a half before interest rates come down again, and then they'll be refinancing. So why pay the higher rate on that 30-year fixed if you can get that adjustable rate lower payment now?
Check the full episode on our YouTube channel and on Apple Podcast.